Imagine building something that lasts for generations. Not years, not decades, but over a century. Something your great-great-grandparents started, your grandparents protected, your parents expanded. And then, in just a few days, it's gone. Not slowly, not peacefully, but in chaos. That's exactly what happened to Credit Suisse, one of the most powerful banks in the world, a name trusted with trillions, collapsed in a way that shocked the global financial system. And the strangest part? The signs were always there. Most people just didn't notice. To understand this, we need to go back, way back. 1856, Switzerland. A country known for precision, stability, and secrecy. A man named Alfred Escher had a vision. Europe was changing fast. Railways were expanding, industries were rising, economies were evolving. But all of it needed one thing: money. So Escher created a bank, not just to store money, but to move it, to fund growth, to build infrastructure, to power an entire economy. That bank would later become Credit Suisse. And for more than a century, it worked. It survived world wars. It survived economic collapses. It survived global crises that destroyed other institutions.
By the time we reached the 2000s, Credit Suisse wasn't just a bank. It was a financial giant, managing over $1.7 trillion. That's more money than the entire economy of many countries. It felt untouchable, stable, permanent. But that's where things started to change. Because somewhere along the way, Credit Suisse stopped being conservative, stopped being careful, and started chasing something else. Profit. Faster profit. Bigger deals. Higher risk. The kind of moves that bring massive rewards, but also massive consequences. At first, nothing seemed wrong. The bank kept growing, revenue kept coming in. Everything looked fine from the outside. But inside, the foundation was starting to crack. The first major warning sign came in 2014. Credit Suisse admitted to helping wealthy American clients hide money from the IRS. Not accused, not suspected. They pleaded guilty. Billions of dollars were hidden through secret accounts. The penalty? $2.6 billion. A massive fine. But here's what matters more than the number. Nothing really changed. No major accountability, no deep reform. Just a payment, and business continued as usual. And that pattern became dangerous. Because when mistakes don't lead to real consequences, they don't stop. They grow. A few years later, something even stranger happened. In 2019, Credit Suisse was caught spying. Not online, not through data, but physically. They hired private investigators to follow a former executive through the streets of Zurich. It sounds unreal, but it happened. The situation escalated publicly. It became a scandal. The CEO resigned. But once again, the system didn't truly change. And that's what made everything worse. Because the real problem wasn't one scandal. It was the culture. A culture where risk was ignored, where warnings were dismissed, where short-term gains mattered more than long-term stability. And eventually, that culture caught up with them. Then came 2021, the year everything started breaking. First, Greensill Capital. Credit Suisse had billions tied to it. When Greensill collapsed, $10 billion of client money was suddenly frozen. Gone. Money that people believed was safe. But before the bank could even recover from that, another disaster hit. Archegos Capital. A single client, using extreme leverage, taking massive positions in the market. And when those positions collapsed, it happened fast. Within days.
Other banks reacted quickly. They cut their losses. But Credit Suisse didn't move fast enough. And the result? A $5.5 billion loss from one client, one decision. That's not just bad luck. That's failure at the highest level. By the end of 2021, the damage was clear. Billions lost, reputation destroyed, trust weakened. But the bank was still standing. Barely. And what it needed most at that moment was stability, strong leadership, clear direction. Instead, it got confusion. Multiple CEOs in a short period, constant strategy changes, no clear plan. And when people lose confidence in leadership, they start to leave. By 2022, that's exactly what happened. Rumors started spreading. Questions started rising. Is the bank stable? Is it safe? And in banking, those questions are dangerous. Because banks don't run on money alone. They run on trust. And once trust starts breaking, everything else follows. Clients began pulling their money out, not slowly, but rapidly. Over $110 billion withdrawn in just a few months. A massive collapse in value. Almost everything gone. But the most shocking part came after. $17 billion in bonds completely wiped out. Investors who believed they were safe lost everything overnight. And suddenly, the fear wasn't just about one bank anymore. It was about the system itself. Because if something like this can happen here, it can happen anywhere. And that leads to the real question. What does this mean for you? The answer is uncomfortable. Because Credit Suisse didn't fail overnight. It failed slowly. Through years of ignored warnings, through repeated mistakes, through a system that allowed problems to grow instead of fixing them. And the truth is, this pattern isn't unique. It exists in many places, hidden behind strong brands, big numbers, and long histories. Credit Suisse survived wars. It survived economic collapse. But it couldn't survive its own decisions. And that's the real lesson. No institution is too big. No history is too strong. No reputation is permanent. Because when trust disappears, everything else follows. After 167 years, the name Credit Suisse quietly disappeared. No dramatic ending, no final moment. Just a slow fade into another bank. And somewhere, people who spent their entire careers there watched it vanish. Not because it had to, but because it was allowed to happen. And unless something changes, this won't be the last time we see a story like this. Different name, different bank, same ending. End.